Every day, millions of tons of raw materials move across the globe. To track this massive physical trade, markets rely on financial indices. An index acts as a unified barometer. It condenses massive amounts of data into a single number, allowing us to track overall price direction and market sentiment at a glance. With the stock market, building an index is straightforward. An equity index tracks the spot prices of underlying company shares, and those shares exist on a continuous, infinite timeline. A company's stock doesn't expire. But commodity indices face a unique structural problem. They don't track physical spot prices, they track commodity futures contracts, and those contracts have a hard expiration date. Every month, the underlying assets technically cease to exist and are replaced by new ones. Because these physical contracts have a finite lifespan, a continuous commodity index is a financial illusion. To stitch these temporary assets into a permanent market barometer requires a very specific type of financial engineering. Since the index tracks futures contracts rather than spot prices, it must constantly account for the mathematical cost of carrying that future over time. To solve this, commodity indices operate as a total return index. A total return index calculates two distinct streams of value simultaneously. The first is simple, the basic capital appreciation or depreciation of the underlying futures contract as market prices move up and down. The second component is the roll yield. This is the financial value generated when an expiring contract is sold off and a new, later-dated contract is purchased to maintain exposure to the commodity. That transition creates a measurable price gap. If the market is in contango, where future prices are higher than current prices, rolling into the more expensive contract generates a negative roll yield. If the market is in the downward curve of backwardation, rolling into a cheaper contract generates a positive yield, adding excess return to the index. An investor tracking a commodity index is tracking something highly specific. They are tracking the mathematical strategy of rolling futures contracts over time, rather than just the raw price of a barrel of oil or an ounce of gold. To build a legitimate benchmark, the Securities and Exchange Board of India enforces strict regulatory scaffolding. The goal is to prevent any single asset from being used to manipulate the broader index. The first filter is age. A commodity future must have actively traded for at least 12 months. It also has to prove consistency, registering actual trades on at least 90% of the available trading days during that year. If a commodity survives the age and consistency tests, it faces a stringent liquidity threshold known as the average daily trading volume, or ADTV. SEBI sets absolute minimums here. An ADTV of 75 crore rupees for agricultural commodities and a massive 500 crore rupee daily minimum for non-agricultural commodities. Once those thresholds are met, the exchanges apply a portfolio rule. Commodities that meet these deep liquidity marks must make up at least 80% of the total weight of the final index. By actively filtering out thin, illiquid markets, the index becomes structurally immune to price manipulation by rogue traders. You cannot corner an index if you cannot corner its massive underlying components. Once a roster of eligible commodities is finalized, the exchange has to determine exactly how much weight each component carries in the basket. The intuitive approach is to look at the sheer scale of the physical market. How much wheat is actually grown? How much oil is pumped? The exchanges do calculate that deliverable supply, known as production value. But they weigh it directly against a second metric, liquidity value, which tracks the average trading volume of the futures contracts themselves. SEBI mandates a strict ratio for this calculation, 25% production value and 75% liquidity value. To enforce diversification, no single commodity is allowed to exceed a hard cap of 30% of the total index weight. By weighing liquidity 3 times heavier than pure physical abundance, index engineers prioritize financial tradability. The index represents the commodities that are actively changing hands in the market, rather than simply sitting in a warehouse. With the weight set, the index is live. But every month, it faces a critical point of vulnerability, the day those near-month contracts expire. If an exchange dumped all its expiring contracts and bought next-month contracts simultaneously on expiration day, the massive volume would destroy market depth and violently distort prices. The solution is a staggered transition over 3 trading days. On day 1, 1/3 of the index weight smoothly shifts into the next month contract. The remaining weight transfers symmetrically over days 2 and 3, completing the transition without shocking the market. During this window, data hygiene is strictly controlled. Non-bona fide orders, like paired calendar spread trades, are actively ignored in the index calculation to ensure the price reflects genuine, single-sided market demand. This staggered rollover engine successfully takes a constantly dying series of contracts and projects the illusion of a continuous, unbroken market trend. That continuous trend allows the exchange to turn a theoretical mathematical model into a concrete, tradable derivative contract. Traders execute positions directly against this basket using index futures and options. Crucially, unlike single commodity contracts, index derivatives are purely cash-settled. There is zero risk of being forced to take physical delivery of a warehouse full of zinc or cotton. These are substantial financial instruments. The minimum lot size to trade an index derivative is 5 lakh rupees. On expiry day, settling a contract of that size requires precision. The exchange determines the final settlement price by taking the weighted average of all traded prices of the constituent futures in the final hour of trading, exactly between 4 and 5 p.m. Relying on that highly compressed 1-hour window demands massive market liquidity. It guarantees that the final settlement price is anchored to actual, heavy trading volume, preventing any last-minute manipulation. Because they are cash-settled and deeply regulated, these complex basket derivatives solve major logistical problems for institutional players. Consider corporate hedging. A major construction firm holds massive exposure to the prices of copper, aluminum, and zinc. Rather than managing distinct futures positions for every single raw material, they can short a broad metal index to hedge their entire sector risk in one trade. Or look at agricultural production, where yields heavily depend on rainfall. An agricultural composite index effectively functions as a macro-level monsoon derivative. If a strong, well-distributed monsoon guarantees a massive harvest surplus, farmers and processors can short the overall index to protect against the inevitable drop in physical prices. For the financial sector, the utility is regulatory. Mutual funds and alternative investment funds are generally prohibited from holding physical inventory. Index derivatives allow them to gain direct exposure to commodity trends while strictly avoiding the legal hurdles of owning physical goods. By stripping away the messy logistics of shipping, storing, and grading physical cargo, indices elevate commodities into clean, compliant assets suitable for modern institutional portfolios. But this structural stability creates an inherent challenge. Despite their utility, commodity indices in India frequently struggle to match the immense popularity and liquidity of equity benchmarks like the Nifty 50. The issue stems from the mathematical law of averages built directly into the basket design. Because an index tracks multiple diverse components, a sudden massive price spike in one commodity, like crude oil, is frequently dampened by a routine drop in another component, like silver. The overall index movement remains muted. That lack of intraday volatility frustrates day traders, who require sharp price swings to generate their profits. Without speculators driving daily volume, overall liquidity drops. This creates a volatility paradox. The exact mathematical dampening that makes an index boring for a day trader is what makes it reliable for a corporate hedger. The true power of a commodity index does not lie in explosive price action. Its value is in its engineering. Ultimately, it provides a mathematically rigorous, total return representation of the essential raw materials driving the entire global economy.